Nick, good to have you back. Any surprises here coming from the Fed?
Susan, the surprise was not the Fed. As you indicated, everybody was anticipating Operation Twist. If anything, the nuance was that it was a $400 billion program instead of $300 billion, and a somewhat larger percentage, 29%, to longer dated instruments. So where I'm surprised is how big a move it produced, since we were all anticipating it. As you first pointed out, in one respect, the Fed got what it wanted. It got the long-term Treasury yield down below 3%. It had been over 3.20 before the announcement. That's a huge move, and that produced the so-called flatter yield curve. But the surprise then was to see such a negative response in the stock market, as you indicate, off almost 3%, and then in particular the banks to take such a heavy hit in addition to the ratings agencies' actions. So that's where I was surprised, was the magnitude of the move on the long-term yields coming down and the stock market selling off.
Yeah, despite the fact that we had Operation Twist pretty much priced into the markets, there are still some investors who are disappointed. We heard from Barton Biggs. He's been called the ultimate big picture man. He said markets apparently were hoping for a large magic pill for the anemic economy that's catching a flu. Did they really think that they would announce QE3?
Well, Susan, that's been the hope and the prayer of the equity market, and I just don't understand it, quite frankly. The Fed all along has never, indicated that it was about to move there. I never expected QE3. I think, Susan, that they will keep that in their back pocket if we start to see more of a weakening, and in particular if you go from inflation to deflation. But, they had three dissenters on the Fed, the same three, and they all were saying, well, inflation's too high. So they didn't even want Operation Twist. So I do think part of the explanation is that. The other thing, Susan, I would point out is when you have a very flat yield curve, think of what banks have been doing. The Fed injects money. The banks get very cheap money. They're not making loans, so they go put it in the bond market. But if now yields come down at the longer end where they invest, their spread, their margin, has shrunk. So I think that was another factor why the financials took an added hit, in addition to the downgrades that you spoke about.
That's right. The flatter yield curve means they make less in terms of their interest margins for loaning out their cash. Okay, but we also got some statements from the Fed as well, which again points to slowdowns in the global economy. For instance, significant downside risks to the U.S., and they're talking about strains in global financial markets. What does that mean?
Well, I think they're just coming to reality, because they actually, Susan, they first say, well, the economy's weak, but we still expect that it will be getting better. So they don't want you to lose confidence, but I think they're just coming to reality. The whole market knows about the strains in the financial system, and that's for me as an investor. I'm saying, Fed, tell me something I don't know, and that's why I don't react to that. Now, maybe there are some other people that say, oh, my gosh, do they know something we don't know? But I didn't find that as new news. I more or less expected that.
Okay. Well, Nick, then tell me this. After today's announcement, where you pretty much got what you expected, are you making any changes to your portfolio at all?
Well, Susan, the hardest thing for us, the answer is not immediately, but here's the biggest challenge. Our parent is an insurance company, financial institution. And again, we back products by buying bonds and trying to earn a spread. And I think that the most difficult thing for financial institutions, banks, insurance companies is, what do you do when now interest rates are this low? The Fed has told you it's going to keep them low for 2 years at least. And now it's not just the short-term rates, it's the long-term rates. So my argument is that I don't have to worry about rising interest rates, but I do have to worry a little bit about credit risk. And so we're being more defensive there.